In 2008, the entire world economy collapsed. Banks vanished overnight. Millions lost their homes. Nobody went to jail. And somehow, this all started with houses. Picture a neighborhood. Every house costs $100,000. Banks are handing out loans like candy on Halloween. Nobody is asking questions. Nobody is worried yet. Banks would lend money to almost anyone. Good credit, bad credit, no credit. Warm body, working pulse. Congratulations, here is a mortgage. Please sign here and here and here. These loans were called mortgages. You borrow money to buy a house. You pay it back slowly over 30 years. Simple, sensible, boring, until someone got very creative with them. Wall Street looked at all these mortgages and thought, what if we bundled thousands together and sold them as one giant product? They called it a mortgage-backed security. Sounds safe, right? Rating agencies, the referees of finance, stamped these bundles AAA. That means ultra safe, top grade, the gold standard, the financial equivalent of a gold star sticker, for garbage. Banks sold these products to pension funds, foreign governments, insurance companies, grandmothers with retirement accounts. Everyone bought them. Everyone trusted the gold star. Big mistake. Meanwhile, house prices kept rising. Everyone assumed they would rise forever. Builders built more houses. Buyers bought more houses. Lenders lent more money. The party had no last song. Can they actually afford this loan? Does it matter? We're selling it tomorrow anyway. The loans got passed from bank to bank like a hot potato. Each time the risk disappeared, on paper. In reality, it was just hiding, dressed up, renamed. Still toxic underneath. There was also a second evil genius product called a CDO, collateralized debt obligation. Take bad loans, bundle them, slice them into pieces, sell the pieces, repeat until rich. Now, add one more spicy ingredient, the credit default swap. A bet. You bet a loan will fail. If it fails, you win enormous money. Some people on Wall Street were betting billions it would all collapse. The whole thing looked like this. Banks gave loans, bundled them, sold them, insured them against failure, then bet on that failure themselves. Like selling a faulty car, then taking insurance out on it. By 2006, house prices had been climbing for a decade. Loans were being handed to people with no income, no jobs, no assets. They were called ninja loans. No income, no job, no assets. Truly. Income verification. I said I'm a time traveler. Approved. Interest rates had been low since 21 after the dot-com crash. Cheap money flooded everywhere. Borrowed money is cheap money. Cheap money finds risk. Risk finds housing. Housing finds trouble. In 24, the Federal Reserve began raising interest rates. Slowly at first. Mortgages became more expensive. Monthly payments jumped. Some homeowners started doing math they hadn't done before. Homeowners who had adjustable rate mortgages watched their monthly payments double. Some had been paying $200 a month. Suddenly, it was $400. Then, $800. Then, impossible. People started defaulting. That means they stopped paying. When too many people stop paying at once, the mortgages inside those fancy bundles start going bad. Like one rotten apple in a giant barrel. House prices peaked in 2006. By 2007, they began falling. Slowly. Then faster. Then very fast. The same houses that everyone bought as guaranteed investments were now worth less than the loans on them. My house is worth less than my mortgage. Fascinating. Have you tried not being poor? Foreclosures began. Banks took back houses. Neighborhoods filled with empty homes. Property values around those empty homes fell too. It was contagious. Failure was spreading like a cold through an office. The mortgage-backed securities that everyone bought started losing value. The AAA-rated products were hemorrhaging worth. Pension funds were bleeding. Insurance companies were bleeding. Everyone was bleeding. Bear Stearns was one of the first big dominoes to wobble. Two of its hedge funds, which had bet everything on mortgage products, collapsed completely in June 2007. Two funds, gone. One, overnight. Banks stopped trusting each other. If a bank calls another bank and asks for a loan, and the answer is no, that is a very bad sign. That sign appeared everywhere in late 2007. The music was stopping. Liquidity dried up. That fancy word means nobody would lend money to anyone anymore. Banks hoarded cash like survivalists hoarding canned food. The whole financial system was seizing like a broken engine. September 7, 2008, the U.S. government took over Fannie Mae and Freddie Mac, two giant mortgage companies. Together, they guaranteed half of all American mortgages. Half. The government blinked first. Then came the moment everyone remembers. September 15, 2008. Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. The largest bankruptcy in American history. The floor fell out. The shockwave hit instantly. Stock markets worldwide dropped. Asian markets collapsed before American ones even opened. European banks panicked. Phone lines at central banks rang simultaneously. AG, the insurance giant, had insured trillions in those bad mortgage products. Now it had to pay out. It had nowhere near enough money. The U.S. government faced a choice: bail it out or watch everything burn. We need $700 billion now. For what exactly? To prevent everything from ceasing to exist. Congress passed the Troubled Asset Relief Program, TARP, $700 billion. Taxpayer money. It went to buy the toxic assets drowning the banks. The voters were not asked if this was okay. The Federal Reserve also slashed interest rates to near zero and pumped money directly into the financial system. It was called quantitative easing, or in plain English, printing money and hoping for the best. Meanwhile, on Main Street, real people were losing real jobs. 8 million jobs disappeared in the United States. People who had nothing to do with mortgage-backed securities lost everything anyway. Life is unfair. Retirement accounts shrank by trillions. People who worked 40 years watched their savings lose half their value in months. The stock market fell 50%. 50%? Bill, in under 18 months. I saved my whole life. Where did it go? Into a computer model that assumed houses never fall. The crisis spread globally. Iceland's entire banking system collapsed. Ireland nearly followed. Greece entered a decade of austerity. Spain's unemployment hit 25%. It infected everywhere it touched. Car companies collapsed next. General Motors went bankrupt. Chrysler, too. These were not banks. They made cars. But no one was buying cars. Because no one had money. Because banks had broken everything. The Federal Reserve's emergency meetings ran through nights and weekends. Unprecedented. Bernanke, who had spent his career studying the Great Depression, was now living the sequel. He looked tired, very tired. Obama won the 2008 election in part on the promise to fix the economy. He inherited a burning building. The first briefing he received as president-elect described a financial system on the edge of total dissolution. The stimulus package, $800 billion. Infrastructure, tax cuts, unemployment, benefits. The government became the spender of last resort. It borrowed to plug the hole that the banks blew open. We need a bailout. And my mortgage relief? Ha! The banks got bailed out. The bankers kept their bonuses. The homeowners lost their homes. Over 10 million foreclosures between 2006 and 2014. The people who caused it were largely protected. Facts. Public rage was enormous. The Occupy Wall Street movement began in 2011. Thousands camped outside financial buildings demanding accountability. They chanted. They camped. Then slowly, they went home. Nothing changed. In 2010, The Dodd-Frank Act passed. New rules for banks, stress tests, consumer protection bureaus. It was supposed to prevent it ever happening again. Wall Street lobbied to gut it almost immediately. Almost. Not one senior Wall Street executive went to prison for causing the crisis. One person, went to jail. A mid-level trader from Credit Suisse. The system that collapsed the world economy faced essentially no criminal consequences. The recovery was slow, painfully slow. For the wealthy, it took 2 years. For the middle class, closer to a decade. For the poorest Americans, many economists argue full recovery never arrived. Never. Who is responsible for this? The market. The banks. The market. The crisis did permanently change some things. Banks must now hold more capital reserve. Mortgage lending standards tightened slightly. Derivatives got marginally more transparent. Marginally. Very marginally. The political consequences were enormous. Trust in banks collapsed. Trust in government collapsed. Trust in experts collapsed. A generation of young persons grew up watching institutions fail them, and remember it still. The Tea Party rose on the right, Occupy rose on the left. Both movements were powered by rage at the same event. The bailouts became a cultural wound that never fully healed. It is still not fully healed now. The wealth gap widened dramatically after 2008. Assets like stocks and real estate recovered. Things the wealthy owned. Wages stagnated. Things workers relied on. The crisis redistributed upward, significantly upward. The crisis exposed something important. The financial system had become a machine that served itself, not businesses, not workers, not communities. A machine for generating fee income for the people running the machine. Some people saw it coming. Michael Burry, John Paulson. A handful of traders who read the actual loan documents and understood what they contained. They bet against the whole system and made billions. Billions. The film The Big Short came out in 2015 and explained all of this using celebrities in bubble baths. It won an Oscar. Sometimes, the best way to understand financial collapse is through Ryan Gosling. Apparently. Could this happen again? Different name, same game. In 2023, Silicon Valley Bank collapsed. A smaller echo.oa. The same basic mechanism. Fast-moving risk that nobody wanted to admit was risk. Regulators scrambled again. Depositors panicked again. Pattern recognized. What did we learn? That risk does not disappear when you rename it. That complexity is often just camouflage for fraud. That systems built to serve themselves will eventually eat their hosts. Slowly at first, then all at once. The world recovered. Slowly. Unevenly. Incompletely. Growth returned. Markets climbed back. Confidence crept back in. But the foundation underneath had shifted. Something important had cracked and never quite been repaired. And somewhere right now, in a glass tower, someone is building a new product nobody fully understands yet. And someone else is stamping it AAA. And the music is playing. And everyone is dancing. Still. I didn't.